What are state corporate tax liabilities? Have you ever wondered how much tax a corporation has to pay to a state? State corporate tax liabilities are the amounts that corporations owe based on their income, activities, or presence in that state. These taxes come from state laws that requiring businesses to contribute to the local economy where they operate. Each state has its own rules, rates, and methods for calculating these taxes. Generally, the idea is that corporations pay taxes for the privilege of doing business in that state. To figure out how much tax a corporation owes, you start with the corporation's taxable income as defined by the state tax code. This often begins with the corporation's federal taxable income, which is then adjusted by adding or subtracting state-specific items. For example, some states might add back certain expenses or exclude specific income items to align with their tax goals. This means that the taxable income can look different depending on the state. Many states use an apportionment formula to divide a corporation's income among the states where it operates. This formula usually considers factors like property, payroll, and sales within the state compared to the corporation's total property, payroll, and sales everywhere else. Once the income is apportioned, it is multiplied by the state's corporate tax rate to determine the tax liability. In addition to the corporate income tax, some states impose extra taxes. For instance, Kentucky has a limited liability entity tax that applies to certain businesses based on gross receipts or profits. This tax has specific thresholds and sliding scales to calculate what is owed. Interestingly, paying this tax can reduce the corporation's income tax liability. Corporations must file state corporate income tax returns every year. They report their income and calculate how much tax they owe according to the state's rules. If a corporation expects its tax liability to exceed a certain amount, it may need to make estimated tax payments throughout the year. Many states now requiring electronic filing to speed up processing and improve accuracy. Limited liability companies, often called LLCs, may have different tax treatments depending on how they choose to be taxed. An LLC that opts to be treated as a corporation for federal tax purposes must also file and pay corporate income tax at the state level. On the other hand, single-member LLCs that are disregarded as separate entities usually have their taxes processed through their owner's individual returns. To sum it up, state corporate tax liabilities are determined by each state's tax laws, which define taxable income, apply apportionment formulas, set tax rates, and establish filing requirements. These liabilities reflected the corporation's economic activities within the state and contribute to funding public services and infrastructure. Understanding these taxes requires careful attention to each state's specific policies and legal requirements.